10-year, 2-year spread. Are we inverted yet? We getting close. We getting damn close. What does all that mean? So one thing that is considered what we call an indicator of a recession. There's several indicators of a recession, but one of them is when the 10-year, 2-year. I did an entire YouTube video on the inversion and what it can mean. But basically, you're talking about short-term. Growth is outpacing what's considered the long-term growth, which isn't the sign of a healthy economy. And so what you want your treasuries to be cheaper in the short term than they are in the long term, but it inverts. It's a bad sign. Plus you've got oil all-time high and stuff like that. So there's a lot of things that everyone is considering that is considered, signs of a recession. So for those of you guys who are wondering, like, why is this such a big deal? Doesn't mean it is a big deal. But just so you guys are aware, the last time that this happened was right after COVID. Remember? Right after COVID, we saw the yield curve invert for the first time. And then we ended up seeing, we saw it right before COVID ended up happening. And everybody was like, holy shit, it was an indicator for a recession because we did go into a recession. We didn't necessarily go into a recession because the recession is 2 months or more, or 2 quarters or more of a slowdown or reversal of GDP. So we kind of hit a recession, but kind of didn't because the Fed kind of printed us out of it. But that was an indicator that we were going to have a fall, right? And, which is funny because even though nobody knew that COVID was coming, if you would have followed this indicator and started shorting the market at that point, you actually would have eventually made a shitload of money a few months later. Now, if you scroll back out, okay, here's 2007 to 2008. Everybody remembers. Here's the dot-com bubble. There's COVID, oil crisis. So for those of you guys who are wondering why people make such a big deal about the inversion, these are the times that the yield curve inverted, okay? All followed by 20% market falls, 20% plus. Another thing that is a recession indicator is oil prices being over $100 a barrel, which have been until today, obviously. Now, that does not mean that we are going into a recession or a market crash. It's just an indicator. Just an indicator. That's all I'm going to say about that. There's no knowledge. Remember, things change, times change. Remember, at this time, the difference between this time and last time is that the Fed got ahead of it this time instead of playing catch up like they did in 2007, 2008. The difference here is that rates are only just now going up. So, no, I'm not saying that it's different this time, okay? All right, you can get cheated on so many times and you say, it's different this time. Okay, how is inversion an indicator if it's right 100% of the time? Because you're looking at it from 4 points. That's not every recession. If it was every recession in history, sure. Let's say we're not inverted yet, but let's say we invert here and we don't go into recession, then it's no longer it's not a guarantee. I would say 4 is not a guarantee. I would say it's a good indicator, but it's not a guarantee. Well, a recession isn't about the stock market. The recession is about the GDP. So GDP, your gross domestic product, the output of your country, if it reverses or stagnates, but mostly reverses, like it dips or goes negative, for 2 quarters in a row, you get into a recession. That means growth has stalled or gone back. That is a recession, a recess, a break. So recess is like at school. Your recess is a break, right? So a recession is a pullback. So recession is an economic term. A bear market is the price at which markets are trading as compared to their previous all-time high. So if a stock market is down, whether the S&P, the New York Stock Exchange, the Dow, if they're down 20% from their all-time high, that means we are in a bear market, okay? A bearish market means that it's, down, slow, trending to the downside. A lot of people say, oh my God, we've had 5 red days in a row, or we've been red 2 months in a row. We're in a bear market. No, that's not what bear market is. It's easier if you just say it's like your hairline. Eat shit. How do you not lose your money during a recession? I mean, the best thing you can do during a recession is what's called protect your capital. How do you protect your capital? You utilize, because during recessions, generally you have low rates, right? So you utilize that. This is what I told everybody 2 years ago when the rates dropped. I said, guys, if we do have a recession, because we didn't know what was going to happen after the COVID crash, I said, go refinance your fucking house. Some of these guys went out and changed their mortgage from a 4.5 to a 2.8 to a 3%, whatever. That saves them a shitload of money. They refinanced all their debt. They paid down their debt. That's what you do. because you don't know how long a recession is going to last. You don't know how long it is till the market's going to come back. That is a risk, and that is an unknown. What is known is that your debt and your payments are going to continue. And if you're making less money, or you're having to cut costs, or somebody in your household loses a job, you can't keep up with the payments. That's why before it happens, or when rates go down, you don't waste time. You refinance. You get that shit under hand. And that way, if there is a recession, you protect yourself. If there's not a recession, sure, you don't have as much money to throw at the market, but guess what? Rates are still low. You can go out and borrow money to throw at the market if you want that hard, right? So you can do whatever you want. Or take a loan out against your house. Or not that you ever should do this to put it into markets. I know there's some degen out there, but you could always take a second mortgage, or you could always take a loan out against the equity in your home. And now that you have a low rate, you don't have to worry about it. And the rate on that loan is even low. So then you can decide what you want to do from there. Okay. Is it worth taking money out of your crypto to add to stocks? I mean, I think it's worth taking money out of any asset and putting into another asset if you're diversifying your portfolio. Because imagine if you were all in one stock, right? And it crashes, you're done. Or if the market goes from like 2008 to 2013, it took 5 years for us to get back to even. These are things that can happen. So you have to diversify. But I don't like the idea of being overly diversified, because if you're overly diversified, you just fuck yourself.